Hello, this is Rochelle Agatha, and this is the lecture on beginning the accounting cycle. The learning objectives for this chapter are journalizing, which requires analyzing, recording business transactions, posting, which is transferring information from the journal to the ledger, and preparing a trial balance. So let's talk about journalizing first. Accounting cycle normal procedures occur over a period of time. They take place over an accounting period, and usually it's 1 year. Some companies have a calendar year. Some companies have a fiscal year. A lot of governmental agencies use a fiscal year. The period of time covered by the income statement can be monthly, quarterly, annually. So the income statement covers a period of time. It's called a natural business year, so usually at the slowest time of the year. So interim reports are the monthly, quarterly, and the annual happen at the end of the year. The general journal is called the Book of Original Entry. It's the simplest form of a journal, and all transactions are located there. Remember what I mentioned in previous lectures, that it feels like you're learning something very archaic, but it's like learning a language. We have to do it on paper and talk about the terminology. People who learn accounting by entering data in accounting systems are data entry people, and they do not ultimately understand the big picture of accounting. The relationship between the journal and the chart of accounts is as you see here. Assets, liabilities, owner's equity, revenue, and expenses. Most companies create a number sequence, and this is very typical. Sometimes it's thousands versus hundreds, depending on the number of accounts you have. So in your mind as the accountant, you remember that revenues are all in the 4s, expenses are in the 5s, etc. The chart of accounts is your index. The debit portion of the transaction is recorded first, and the credit goes second. And then you have an explanation of the entry, and then you have a space to go on to the next one. And you'd be surprised, even in our technological world, that this is very similar in all companies. And people who learn this right understand accounting. So let's do a journal entry. So Brenda Clark began the business by investing $10,000 in cash. So here you have your year. You debit the cash, you credit the investment into the capital account, and you have a description, a title, a debit, a credit, a page number, etc. This is the way a journal looks. Notice that there's the day, the amount debited, the amount credited, the explanation, etc. Let's do another one. Purchased word processing equipment from Ben Company for $6,000, paying $1,000 and promising to pay the balance in 30 days. Okay, this triggers in your mind that you paid some cash, then there's this promise to pay. That's an accounts payable. So you have your word processing equipment, that's your asset. You paid some cash and you picked up debt for the difference. There's your description. Notice it's set up exactly the same way. This is a compound journal entry. It has more than one debit or credit. Only the day is entered if the transaction before contained the year and the month. Now you rented office space, paying $1,200 in advance for the first 3 months. So this is prepaid rent. You don't get to expense something that hasn't yet occurred. This is accrual accounting, the difference between cash accounting and GAAP accounting. So you record this asset and you decrease your cash. Then you purchased office supplies on account for $600. Here you're incurring an asset and you're incurring debt. On May 7th, you completed sales promotion pieces and you collected $3,000. So here's your word processing fees and cash. This is a revenue account. Fees is a term that is used for revenue and expense. You have to be careful when you're in beginning accounting. Then you paid office salary expense. So you have cash and you paid some salary expense. Then you had an advertising bill, which hadn't yet been paid. So you put the debit in accounts pay or the credit in accounts payable at the time that the expense was incurred, even though you don't pay it. This is also accrual accounting. This is GAAP accounting. Brenda Clark wrote a check on the bank account to pay her home mortgage. So this is a withdrawal because you don't mix your personal life with your business life. And a lot of self-proprietors don't really understand this, but you keep a separate set of books for your business. Then you billed Moore's company for sophisticated word processing job. they haven't paid you that one. Again, there's your revenue and your accounts receivable. You paid your office salaries, so there's your salary expense. You paid half of the amount owed for the word processing, so you paid off some debt and decreased your cash. You received and paid the telephone bill all at once, so notice the expense and cash happen at the same time. Let's talk about learning objective 2, posting and transferring information from a journal to a ledger. It involves several steps, and I'm going to go ahead and move on. You can read this slide on your own, but basically you're going to see some arrows here. So here is your journal and here is your ledger. Every account has a spot in the ledger. So here's the cash ledger account, and here's the journal. So you're going to post the debits and credits and take your totals across the side so you have an ultimate balance total, whether it be a debit or a credit. You put a post reference in, which is the page from the general journal page 1, general journal page 1, and then you put the date and you have the title and the account number. This is very typical posting from the journal to the ledger. The ledger is your summary. If you're keeping flashcards, these are good terms to put on your flashcards. The post reference column tells us which transactions have not been posted, and that's your cross reference. Now let's talk about preparing a trial balance. So a trial balance is a list of all the individual accounts balances taken from the ledger. So you do your journal for a month. Then you do all your transactions in your ledger for a month. Then you post your all of your transactions to its individual ledger account. And then from there, you're going to make a trial balance. So let's see if we can go through that. Here's your trial balance. Your trial balance is in order of liquidity of the balance sheet. So cash is always first. Liquidity is a term meaning how quickly can something be turned into cash. So cash, accounts receivable, office supplies, prepaid rent, then your equipment. Your equipment takes longer to sell and be able to liquefy. Then come your debts, your accounts payable and other debts, then your capital, then your revenue, then your expense. So this debit came from the cash ledger account. So here you see that the trial balance lists the accounts in the same order as the ledger. So if you go back and look at the slide, you'll see that that was the ending balance. Notice the totals, double underscore, everything looks nice and neat. Trial balance has an ending date on it. What if your trial balance doesn't balance? And this is a very common occurrence. You first want to find out how much you're off by. If your difference is an even number, like 1,000, then you probably made a math error in the posting. Some of these little tips here don't really, they aren't as important anymore with computers, but if you're doing it all by hand, it's very important to remember these. If you can divide something by 9, it's usually a transposition error, meaning you transposed a number, 33 or 34 to 43 type of a thing. And so go ahead and read these. There's lots of different ways that you could make a mistake since you're manually moving these things. A slight error is from adding or deleting zeros and writing numbers. So what you're going to do is go back and compare the trial balance numbers to the ledger to see if you made a mistake. And I'm not that old, but I remember doing accounting back in the 80s when I got out of college, and we did it all by hand. We didn't have any computers when I was a Price Waterhouse auditor, and so this kind of stuff became really important in the moving of numbers back and forth. And even today, as a CFO like I am now with a huge accounting system, we find at times our trial balance is off, and it's usually because an account didn't get into the system. Not so much that a journal entry got posted wrong because you put controls in your system where it won't let you post transactions that are out of balance, if you will. Okay, so if you're doing this by hand, this seems a little archaic. If you found a mistake, you would cross it off and make some notations before posting it the right way. If you're using computer system, what I make my staff do is if there's an error, I make them reverse the wrong transaction and repost the right one so that I have an audit trail. So you must correct a entry that's been posted to the wrong account. So like I mentioned, I would make my staff reverse the wrong entry and book the right entry. So these are just showing that after you're done and you post the right thing, see, here's your correcting entry. This is, even in a computer system, this is what it would look like. You would see the correct entry coming in. And then there's your ledger at the end. So in summary, there's a lot of slides in summary here. Basically, keep in mind that you start out and you have transactions, and you post transactions on a operational basis monthly. Then you record your transactions and you post them. Then at the end of a month, you're going to close your month, and that is going to take all the information to your ledger. And then at that point, you're going to create a trial balance. So once again, I realize this seems quite manual and archaic, but it's really important that you understand the process in accounting, and so that when you do it in a computer system, you'll get it and you're not just a data entry person. If you have any questions, go ahead and send me an email. Thanks.